Yes, stock picks are spread across a number of different sectors, but they all share one common thread. Joining us to discuss what is working in this low-rate environment is Jason Ware, partner and CIO at Albion Financial. Hey, Jason, great to see you.
Yeah, thanks. Great to see you. Good morning.
Target is one of your stocks. It's got a 3.17% dividend yield. And what stood out to me is that in Monday's session, which was a real tough session, Target really held up. What do you like about this stock?
Yeah, so Target's an attractive valuation against a company that is improving their fundamentals. So you'll note that in 2017, they launched a 3-year, $7 billion turnaround for their stores. And it's a multifaceted 6-point approach in which really the end goal is to try to boost same-store sales. They've done that. We're seeing between 4 to 6% same-store sales comps. Meanwhile, it was a very shareholder-friendly company that's growing the dividend north of 12% per year. Steady payout, almost 50 years of dividend payments uninterrupted with 47-year streak of growth. So just continues to be a really great total return profile and a company we think is undervalued.
Verizon also has a tradition of dividend payouts and increasing them, Jason. I'm wondering why you prefer Verizon over an AT&T and telecom.
Well, Verizon is the leader in the space. And if you look at 5G, I mean, they're going to lead the rollout there. They have great brand value. They get, in terms of quality, they continue to consistently win in terms of customer satisfaction and their network. This is a company that continues to see sub growth. In 2018, they had about 2 million ads. Meanwhile, we think there's an upside in the name. If you look at first valuation, it's around 12 times earnings, has a 4.5% dividend that has been growing. But meanwhile, if you look at the number of connected devices per household and data usage, we think there's still a decent growth story here in Verizon. Meanwhile, you get a nice dividend that continues to grow as well.
Is the media portion of AT&T now a distraction in your view?
I think to some degree it is. Now, to be clear, we also own AT&T for clients as well. It's about a 6.5% yield, and we think the business is doing fine. But there have been more troubles with AT&T and more distractions. Verizon's a little bit cleaner play for now. We think both can work in a portfolio, but we do prefer Verizon a little bit over AT&T.
Defense stocks have really been stalwarts amid this market volatility. What do you think the reasoning behind that is? That's one of your picks.
Well, I think there's a lot of recurring revenue in defense stocks. I mean, Lockheed Martin is one of our favorites. We've owned it for years. This is a company that basically has a near monopoly in fighter jets and a duopoly in missiles and missile systems with Raytheon. There's just a lot of clarity in their businesses. So if you look at the competitive advantages that one has to have in order to continue to win these contracts from defense departments like Lockheed, there's a recurring revenue model there that we think is easy to model out 3 and 5 years down the road that supports the dividend and supports the growth rate. We have about 15% earnings growth rate over the last 3 years for Lockheed. The F-35 has had some problems, to be sure, but they've only delivered about 1/6 of the orders that will come through over the next 15 to 18 years, and we think that's a nice growth driver to the story. So we continue to like the stability that Lockheed provides.
All right, and Cisco's your last pick, 2.7% dividend yield. Jason, we got to leave it there. Great to see you. Thank you. Jason Ware, Albion Financial.